the index fund strategy that builds wealth while you sleep. Hey, what's up, everyone? Welcome back to David Invests. If you are new here, this channel is about one thing: cutting through the noise around money and giving regular people the honest, practical information that actually builds real wealth on a real salary. No hype, no complicated strategies designed for people managing millions of dollars, no courses to sell, just the stuff that works. And if you have been following this series, you know the crew: Chris, the delivery driver; Priya, the hospital administrator; Raymond, the teacher; Keisha, the office manager; Andre and Vanessa working through their debt; Thomas building his foundation at 52; Marcus learning that passive income takes longer than the internet suggests; Diana quietly building investment income, one automatic contribution at a time. Throughout this entire series, I have mentioned index funds repeatedly. I have told you to put your Roth IRA money into a low-cost index fund. I have referenced the S&P 500 and total market funds as the foundation of a simple, powerful investing strategy. I have shown you the math on what consistent contributions into index funds produce over 10, 20, and 30 years. But I have never dedicated an entire video to explaining exactly what index funds are, why they work, how to choose the right ones, and what the complete strategy looks like from start to finish for a regular person who just wants to build wealth without spending hours managing investments. Today that changes. This is the index fund video, the one I have been building toward, the complete picture. Let's get into it. Let me start at the very beginning, because I want this video to be useful whether you have been investing for years or whether you have never bought a single share of anything in your life. What is an index fund? An index fund is a type of investment fund that tracks a specific market index. The most well-known example is the S&P 500, an index that tracks the 500 largest publicly traded companies in the United States. When you invest in an S&P 500 index fund, you are not buying shares of one company. You are buying tiny pieces of all 500 companies at once. Apple, Microsoft, Amazon, Google, Johnson & Johnson, Berkshire Hathaway, 500 companies across every major industry in the American economy, all in one fund with one purchase. When those 500 companies collectively go up in value, your investment goes up. When they collectively go down, your investment goes down. You are not betting on any single company. You are betting on the collective long-term performance of the largest businesses in the American economy. And here is the historical fact that makes index funds so compelling. Over the last 100 years, the American stock market, measured by broad indices like the S&P 500, has returned an average of approximately 10% per year. Not every year. Some years it goes up 30%, some years it goes down 40%, but averaged across decades, the number comes back to approximately 10% per year, every decade. Through world wars, recessions, depressions, pandemics, political crises, and every other kind of catastrophe the last century produced. 10% per year on average, for 100 years, through everything. That track record is what makes index fund investing the strategy that Warren Buffett, arguably the greatest investor in human history, has recommended for regular people for decades. Not because it is exciting, because it works reliably, mathematically, over and over again throughout history. Now I want to introduce two new characters today, people who are just starting their investing journey and approaching it in completely different ways. Meet Jordan, 24 years old, works in marketing at a small company in Austin, Texas, makes $46,000 a year. Jordan is smart, analytically minded, and genuinely excited about investing. He spent 3 months researching individual stocks before putting a single dollar to work. He reads earnings reports. He follows financial news every morning. He has strong opinions about which companies are going to outperform the market over the next 5 years. Jordan opened a brokerage account 4 months ago and built a portfolio of 12 individual stocks he believes in. He spends about 2 hours a week managing it, reading updates, and thinking about whether to adjust his positions. Now meet Sophie, also 24. She works as a nurse in Denver, Colorado, makes $52,000 a year. Sophie has no interest in reading earnings reports or following financial news. She does not enjoy thinking about individual companies. She just wants to build wealth without it consuming her attention and energy. She did about 3 hours of research total, opened a Roth IRA, put everything into 2 index funds, set up a $200 monthly automatic contribution, and has not thought about it much since. Sophie spends approximately 0 hours per week managing her investments. Same age, similar starting points, completely different approaches. And the outcome over the next several decades, as the research consistently shows, is very likely to favor Sophie. Not because Sophie is smarter, not because she got luckier, because the strategy she chose has a consistent historical advantage over the strategy Jordan chose. And understanding why is one of the most important investing lessons I can share. Here is the uncomfortable truth truth about stock picking that the financial media almost never discusses plainly. The majority of professional fund managers, people with finance degrees, research teams, Bloomberg terminals, and decades of experience, failed to beat the S&P 500 index over a 10-year period. Not a small majority. Study after study puts the number somewhere between 80 and 90% of actively managed funds underperforming a simple S&P 500 index fund over 10 years. Let me say that again so it lands. 8 or 9 out of every 10 professional fund managers, people who do this full-time with enormous resources, fail to consistently beat an index that any regular person can invest in for almost no cost. And over 20-year periods, the number gets worse. Over 20 years, approximately 95% of actively managed funds underperform the index. If professionals with every possible advantage cannot consistently beat the index, what does that say about the odds of a regular person doing it by picking individual stocks in their spare time? This is not a knock on Jordan. Jordan is doing what feels logical. If I believe in a company, shouldn't I just buy that company rather than buying 500 companies, including ones I am less excited about? That framing makes intuitive sense. The problem is that the evidence overwhelmingly shows that individual stock selection, even by experts, does not reliably produce better results than simply owning the whole market through an index fund. The market prices in available information extremely efficiently. When you think a company is going to outperform, thousands of professional analysts have already thought the same thing, and that expectation is already reflected in the price. Beating the market consistently requires not just being right, but being right in ways that the entire professional investment community has not already anticipated, and that is extraordinarily difficult to do reliably over long periods. Sophie does not try to beat the market. She owns the market. And owning the market, the whole thing, all 500 companies, all the future winners nobody can predict yet, alongside all the companies that will eventually fade, has produced 10% per year for 100 years. Now let me get into the actual strategy, the specific funds, the specific accounts, the specific order, because I want you to be able to walk away from this video and know exactly what to do. There are 2 index funds that form the foundation of what most financial experts consider a complete, simple, powerful investing strategy for regular people. The first is a total U.S. market index fund. This fund owns essentially every publicly traded company in the United States. Not just the 500 largest like the S&P 500, but thousands of companies including smaller and mid-sized businesses that are not yet large enough to be in the S&P 500. A total market fund gives you exposure to the entire U.S. economy, large companies, small companies, growth companies, value companies, every sector, everything. The most widely recommended options in this category are the Vanguard Total Stock Market Index Fund, ticker symbol VTI if you are buying the ETF version, and the Fidelity Total Market Index Fund, ticker FSKAX, which has no minimum investment and a nearly zero expense ratio. Both are excellent. Both are essentially interchangeable for most regular investors. The second fund is an international index fund. This fund owns companies from developed and emerging markets outside the United States, Europe, Japan, Canada, Australia, China, hundreds of companies across dozens of countries. Adding international exposure means you are not entirely dependent on the performance of the U.S. economy. When the U.S. market underperforms, which it does in some decade-long periods, international markets sometimes outperform and provide balance. The most widely recommended options here are the Vanguard Total International Stock Index Fund, ticker VXUS, and the Fidelity International Index Fund, ticker FZILX. Again, both are excellent and essentially interchangeable. That is it. 2 funds. That is the complete equity portfolio for most regular investors. Total U.S. market, total international market, simple, low cost, broadly diversified, historically effective. Now, how do you split between these 2 funds? This is one of the questions I get most often, and I want to give you a direct answer. The most common recommendation for financial experts for a young investor with a long time horizon is somewhere between 70 and 80% U.S. total market and 20 to 30% international. So if you have $10,000 to invest, something like $7,500 in the U.S. total market fund and $2,500 in the international fund, or $8,000 and $2,000. The exact split matters less than the principle of having broad diversification across both U.S. and international markets. Sophie's 2-fund portfolio is exactly this. She is 80% Fidelity Total Market and 20% Fidelity International, both inside her Roth IRA, both automatically purchased with her $200 monthly contribution. She set this up once and has not touched it since. Some people prefer an even simpler approach, a single target date fund or a single total world index fund that combines US and international exposure in one fund. If you want maximum simplicity and literally just one fund to think about, a target date fund set to your approximate retirement year or a total world index fund like VT from Vanguard are excellent one fund options that do the international diversification automatically. The right answer is not the most perfectly optimized split. The right answer is the split you will actually maintain consistently for decades without second guessing, tinkering, or abandoning during a market downturn. Simplicity that you stick with beats complexity that you abandon every single time. Let me talk about the cost side of this equation, because costs are one of the most important and most overlooked factors in long-term investing for regular people. Every fund charges a fee called an expense ratio. This is the annual percentage of your investment that goes to the fund company for managing the fund. It is deducted automatically and invisibly. You never write a check. It just comes out of your returns. For an actively managed fund, a fund where professional managers are picking stocks and trying to beat the market, the typical expense ratio is somewhere between 0.5 and 1.5% annually, sometimes higher. For a total market index fund, where no active management is required because the fund simply tracks an index, the expense ratio is typically between 0.01 and 0.03% annually, essentially nothing. That difference sounds small. It is not small over time. Let me show you the math. Jordan's actively managed fund charges him 1% per year in expenses. Sophie's index fund charges her 0.03%. On a $100,000 portfolio over 30 years, assuming the same 10% gross return before fees, Jordan pays approximately $155,000 in cumulative fees. Sophie pays approximately $9,000. Jordan pays $146,000 more in fees than Sophie on the same portfolio over 30 years. Not because he made worse investment decisions, simply because his fund charges more. The fee difference alone, not market performance, not stock selection, not strategy, is worth $146,000 over 30 years. This is why John Bogle, the founder of Vanguard and the person most responsible for bringing index funds to regular investors, spent his career arguing that costs are the single most controllable variable in long-term investing. You cannot control what the market does. You cannot control the economy. You cannot time recessions or predict which companies will outperform, but you can control what you pay. And paying as close to nothing as possible, which index funds allow you to do, is one of the highest leverage financial decisions available to any investor. Now I want to address the most common objection to index fund investing, because I hear it constantly in the comments and I want to give it a direct, honest answer. The objection sounds like this: if everyone just invests in index funds, who is going to be doing the price discovery that makes markets efficient in the first place? Or more commonly, what about when the market crashes? Don't index fund investors just lose everything? Let me address the crash question directly, because I think it causes more people to avoid index fund investing than almost anything else. Yes, when the market goes down, your index fund goes down. There is no way around this. If the S&P 500 drops 30%, your total market index fund drops approximately 30%. Your account balance goes down. The number on your screen gets smaller. This is real, and it is uncomfortable, and anyone who tells you otherwise is not being honest with you. But here's what the historical record shows about every single major market crash in the last 100 years. The market recovered every time, without exception. The crash of 1929 and the Great Depression, the market recovered. The crash of 1987, the market recovered within 2 years. The dot-com crash of 2000 to 2002, the market recovered. The financial crisis of 2008 to 2009, one of the worst crashes in modern history, the market not only recovered, but went on to one of the greatest bull market runs ever recorded. The COVID crash of March 2020, the market dropped 34% in about a month, and then fully recovered within 5 months. Every crash, every time, a full recovery followed by new highs. The investors who got hurt by these crashes were not the ones who stayed invested. They were the ones who panicked and sold during the crash, locking in their losses permanently, and then either stayed out or bought back in after the recovery had already happened. The ones who stayed invested simply watched their account go down and then watched it come back up. Priya watched her account drop during a market pullback several months ago and did nothing. Chris watched his account drop and did nothing. They kept their automatic contributions running. They bought more shares at lower prices during the pullback without even thinking about it, because the automation was doing it for them. And when the market recovered, they were better positioned than before the drop. This is the psychological advantage of automation. It removes the decision from the moment of maximum fear. You do not have to be brave when the market drops if your system is already set up to keep investing automatically, regardless of what the market is doing. Let me walk you through the complete setup, start to finish, exactly what to do. Step 1, open a Roth IRA if you do not already have one. Fidelity, Vanguard, and Schwab are all excellent options with no account minimums and no commissions on trades. The account takes about 15 15 minutes to open online. Step 2. Choose your funds. For simplicity, I recommend starting with just two: a total U.S. market index fund and a total international index fund. If you are at Fidelity, FSKAX and FZILX. If you are at Vanguard, VTI and VXUS. If you want maximum simplicity, a single target date fund set to your approximate retirement year handles everything automatically. Step 3. Set your allocation. 70 to 80% U.S. total market, 20 to 30% international, or 100% in a single target date fund if you prefer. Step 4. Set up automatic monthly contributions. Whatever you can genuinely commit to right now. $50, $100, $200. The amount matters less than the automation. Set it up so it happens every payday without you thinking about it. Step 5. Set your dividends to reinvest automatically. Most brokerage platforms allow you to turn on automatic dividend reinvestment with one click. Do it. Every dividend payment automatically buys more shares and compounds your returns without you doing anything. Step 6. Do not look at it every day. Set a calendar reminder to review your portfolio once per year. Rebalance if your allocation has drifted significantly from your target. Otherwise, leave it completely alone. That is the complete strategy. 6 steps, 1 afternoon of setup, decades of automated wealth building. Jordan is going to figure this out eventually. He is going to spend a year or two picking stocks, checking his portfolio daily, feeling the emotional highs of a stock that goes up and the gut punch of one that goes down, spending hours on research that may or may not improve his returns. And at some point, he is going to compare his results to what a simple index fund produced over the same period and make a decision about where his time and energy are best spent. A lot of great investors took this path. They tried active investing first. They learned from the experience, and they eventually landed where the evidence always points: broad, low-cost, diversified index fund investing as the foundation of a long-term wealth building strategy. Sophie is already there. Her portfolio is not exciting to talk about. There is nothing to analyze or optimize or debate. It just runs every month, automatically, growing at the pace of the American economy and the global economy combined, compounding quietly in the background while she focuses on the rest of her life. In 20 years, Sophie's unremarkable, boring, simple two-fund portfolio is going to look like one of the smartest financial decisions she ever made. Not because she was brilliant, because she was consistent, and because she chose a strategy that the evidence has supported for decades and then refused to complicate it. That is the complete index fund strategy. Not complicated, not exciting, just effective, just mathematically reliable, just the thing that works for regular people building real wealth on regular salaries over regular lifetimes. Start simple, stay consistent, leave it alone, let time do the rest. I'll see you in the next one. And as always, if this video finally made index funds click for you in a way that other explanations never quite did, hit subscribe. Every week I put out one video breaking down the money stuff that actually matters for regular people building something real. No hype, no noise, just the honest roadmap. Hit subscribe and I will see you next week.